Hey everyone, me Kevin here. Let's talk about why Jerome Powell is crashing the market. After all, Jerome Powell and Janet Yellen spoke this morning. Janet Yellen, Treasury Secretary, Jerome Powell over at the Fed. So look, both of them, as usual, say we see positive signs in the economy, but we still have a long way to go. This is the same thing that they've been reading from their stupid script for many months now, and it's kind of getting old. Now, currently, they are optimistic, though, because they believe, hey, look, as things start turning more positive, more people are actually, and this was a pretty interesting note, more people are actually joining the labor force, which increases the pool of people looking for employment, but actually does not drop the unemployment rate as fast, so the unemployment rate might be slower to fall because more people are joining the labor force. But Jerome Powell's going, look, more people joining the labor force is actually a good thing. More people getting back to work is a good thing. The economy is on a good path. It's uncertain, but we're on a good path and we're optimistic. That's kind of what Jerome Powell was saying throughout his meeting. Gone through the meeting. There's some other salient points as well, but I specifically in this video want to focus on why the heck would the market be crashing after what, happened with Jerome Powell and Janet Yellen, or what didn't happen. Well, the reality is, most of this is because of what didn't happen. See, Jerome Powell reiterated his belief that, look, we believe the economy is going to do better in the long term. We think growth is going to be amazing in 2021. And interest rates going up, or the yield rather, going up on the 10-year and the 5-year treasuries is a symptom of the market saying, yeah, we agree with you, Powell. The market's going to do great. Because Jerome Powell was asked, hey, what are you going to do? Yields are going up and this is hurting stocks and that's bad. Trump's kind of like, no, I don't think so. I actually think it's a good sign. It's a sign that not only the economy is improving, but it's a sign that the market believes the economy is improving, but it's also a sign that the market believes we're going to get to 2% inflation. And Jerome Powell's like, this is great. This is what I want. My job is becoming a success. And unfortunately, with this kind of attitude, Jerome Powell is doing the opposite of what he did to, in some sense, prop the stock market to the levels where it had been. And that was, we'll backstop everything. And if we need to, we'll just come in and start buying stocks because we're not going to let them fall that much. Which, now, Jerome Powell never did actually buy corporate stocks, but they did buy corporate bonds, which was pretty unprecedented in the United States. And if you buy corporate bonds, well, that kind of is almost a direct bailout of certain companies. But anyway, you buy like Apple bonds and Verizon bonds, it kind of gives those companies liquidity, right? And also, also drives up the price of those bonds, which is good for the companies when they need to sell bonds. But anyway, the point is, Jerome Powell's attitude is such that, look, it's actually, his attitude is actually good news. His attitude is, look, bottlenecks, and this is another thing he said, bottlenecks in supply chains will be short-term. Bottlenecks in chips, for example, will be short-term. We will not have a supply shortage forever. The economy will be resilient and will respond. The economy is on a good path. It's going to take time and more time of support. So don't worry, we're not going to raise rates until 2023, 2024. It's roughly his implication. That's his regular implication. But Jerome Powell is actually happy. He's cheering the current progression of the market. But Wall Street doesn't want to hear that, because when Jerome's like, this is great, the economy's doing better, more people are getting back into the workforce, money is flowing properly, the system is greased again, banks have the correct reserves, everything's looking good, people in the stock market are like, wait a minute, that means this is kind of potentially the end of easy money and this is painful. And so that's why we're seeing this substantial rotation really just out of equities in general. Yesterday everything was down. Recovery stocks were down and tech stocks were down. Today, we've got recovery stocks that started the day out stronger, but they've also started consolidating a little bit. At the time of this recording, we've still got Carnival, we've got Oil, or USO rather, Norwegian Cruise Lines, Dave & Buster's, Cheesecake, Delta, American Express, all of these companies up between 2.5% to 5%. That's great. Now, within the last 20 minutes of filming here, somewhere around 1:30 Eastern time, we have had a little bit more of a pullback in the market. For example, API, the backbone for Clubhouse, is down 11%. Xpeng Motors is down 12%. NEO is down 8%. And we're kind of trending towards my suspicion that we are seeing this double dip in a short period of time here. where we had a few days of reprieve last week. We had some nice green, quite a few days of green. We were happy we bought the dip, but we warned that, hey, just be careful. You don't want to go crazy buying the green right now because we could see a double dip within 10% of the prior dip. Well, that's kind of what we're gearing up for right now, and we're trending into that direction where maybe Tesla goes within 10% of its previous bottom, which previous bottom was like 530. Maybe Tesla revisits 580. I don't think we have a catalyst for really pushing stocks down lower than the March 5th to March 8th lows. And the reason for that is simple: fear. Peak fear was around March 5th and March 8th because Jerome Powell's comments about this is good, yields going up is good, it's a sign the economy is doing well, those were fresh comments then. Those were new. Now the markets are kind of just like, he said the same thing again and we still don't like it. But the fervor, the fear is not at that same peak level we had before. So if you didn't get margin called before, I don't think we're going to be seeing margin calls going forward if you didn't get margin called before. Now, I could be wrong. Stocks could continue to fall past our March 5th and March 8th lows. And that's one of the reasons I've been hoarding cash over the last week as stocks turned green. We've documented this, obviously. And I haven't really been buying. I've been kind of quiet on my alerts because I'm like, I don't know, I'm going to wait for that W-shaped dip. And that's possibly what we're seeing right now. Again, no guarantees it could go down lower, but I think we would need a worse catalyst for it to go down lower. And I think the next big catalyst is getting CPI data next month. Now, personally, I think this is going to be like the opposite of buy the rumor, sell the news. And what I mean by that is I think people's anticipation of this March reading of inflation, the month where stimulus checks are coming up, I think people's anticipation is going to be, oh my gosh, this is going to be horrible for the market. We're going to get such a horrible reading on CPI. It's going to basically guarantee that inflation is happening in the same month that stimulus checks started going out, and then the market's going to sell off. I believe that is a possible assumption of the markets. And I personally believe that when that CPI data comes out, year over year, it's not going to look pretty. But smart investors and funds are going to look past that, and they're going to look at the month-to-month data. They're going to chart a line between January to Feb and Feb to March. And if that inflation data isn't scary, which we do expect that temporarily it might be higher, but as long as it's not scary, then in my opinion, it's likely we'll see that rotation back. We'll see a rotation back to tech and back to growth as opposed to the current present-day trade, which is rotating into value. Which, personally, I agree with Kathy Wood on. I think a lot of value is loaded up with value traps. As things look cheap, they're really high in debt, their growth potential is horrible, but people are buying them because they look cheap. And look, that rotation trade has been working out very, very well for the last few months, really since November. And quite frankly, since November, it would have been better to just be all in on recovery stocks than because the vaccine came out in November, right, or was approved in November. It would have been better to just be all in on recovery stocks than in tech, because a lot of tech and energy is selling off back to November levels, December, November levels anyway. But that's hindsight. So now we have to look going forward. What's cheap right now? Well, tech and energy looks relatively cheap. Price to earnings ratios are still high, but relative to the prices we have seen over the last 6 months, the stocks haven't moved much. There are a lot of stocks that have been flat since August through September. A lot of them were flat through November. This feels like a nice opportunity to pick up some more and concentrate more into some of the stocks we have really high conviction in. For example, this morning in the Stock and Psychology of Money course in our private live stream, we did a solid dive into the annual report from Palantir, and we made associations between the acquisition customer rates versus scale rates at Palantir, and how much potential growth and how much growth we're already seeing, not just potential growth, but how much growth we're already seeing. And so to me, when I see Palantir at 22, I get excited. It's an opportunity for me to grow a company that every time I dive deeper into it, I get more and more enthusiastic about, and my conviction grows. Well, golly, I'm happy. I'm happy to buy at these prices. And I did. In fact, this morning I spent just over $100,000 nibbling on stocks because we've had a nice solid sell-off here. Now, this is a dip that could keep going. Remember my rule of thumb. I think we're going to potentially go to within that 10% range. Could even compress, could even go within that 5 to 10% of previous March 5 to March 10 bottom, or bottoms for multiple different stocks. But I don't think we're going to go past that. And so this is really going to be my trigger point to go shopping out there. And we're getting close to that trigger point. My current expectation is Thursday or Friday. Might be some of the worst of it. Hopefully then weekend effects set in and we have a green next week. We'll see. No guarantees as usual. But that's the way I'm planning my strategy right now. Now, what else did Jerome Powell and Janet Yellen say? Well, not much. In fact, beyond talking about bottlenecks and unemployment and how they're looking forward to getting to this 2% inflation and that yields going up is exactly what they're expecting, they did mention as well that inflation has only averaged 1.7% over the last 10 years. And that despite even all this money printing, they believe it's going to be a little bit of a struggle for us to get over and maintain over 2% so that we can average up to 2%. We'll see. Keep in mind, though, you want to also be careful of options right now, mostly because a lot of people view leaps as very secure, as secure ways to build wealth because, hey, the expiration's in 2 years and we should be good. You never know. The market could potentially trade flat for a couple years. So the money you're investing today, don't expect it to go up like crazy tomorrow, but I would rather be in than not. So this is some of my thoughts right now. Now keep all of this in mind, obviously. Think the thoughts through yourself and see where you align on some of the things that I'm talking about in these videos or on the channel or in the live streams. If you find this sort of information helpful, consider subscribing to the video. Double check that you've already looked or checked out on the amazing course programs linked down below. Use that course coupon code that expires Friday. So within 48 hours, that price is going to go up. Love to have you in there before that. And folks, we'll see you in the next video. Thanks. Bye.